In this video, I'm talking with loan officer Mary Levinson. Now, she's a branch manager. We're going to keep it at loan officer because, look, she originates loans. She's responsible for helping buyers make big financial decisions here when they're buying a house. And, some of what we're talking about is, why are the fees so expensive? A lot of people are forgetting. They want to look at the real estate agent and the commissions and things like that. But a lot of people don't realize these loan officers make a lot of money too. And so she has to deal with some of my questions. And guys, I think you're going to enjoy the show. And if you're a buyer out there, you really need to pay attention, listen up. And if you know somebody that wants to buy a house, maybe you could, after watching this video, you'll think it's good enough to share with the people closest to you. Hope you enjoy the show. All right, Mary, thanks so much for joining me. So just give everybody the 30,000 foot view, who you are, how you got into the business.
Yeah. I'm Mary Levinson. I've been in the industry for 23 plus years at this point. Got in the industry because I was working at a company where I was doing some marketing. A friend of mine approached me, owned a brokerage office, and said, hey, your personality, you know some financing, you're good with clients, come enter into the mortgage industry. Literally, I just leaned into it, took the parachute off, went with full faith, and I just loved it ever since. And I love being with clients. And at this point, I run a branch for 20 years over at NFN Lending, the Levinson McLaughlin team, and have a few employees, a successful branch. Things are going well. It's a funny time. We can talk about that obviously in a minute. But yeah, office is located here in Maryland, work in multiple states. My company itself, NFM, is in 48 states. 30,000 view. Things have been great, and we're in a weird time right now.
We're in a what?
A weird time right now.
A weird time. Right, I'd say a weird time.
Yeah.
So you went through the '08 crisis. Everybody, anybody could be a loan officer back then. So
yes.
What has really changed since then? I mean, other than, and I don't know your business. I try and stay out of it. I handle the sales side of things, the brokerage side, real estate sales brokerage side of things. So what has really changed? Because I had said something to someone that said you always needed a license to be a loan officer. But I don't remember it that way. Did you always need to be licensed prior to the '08 crisis?
No, your memory serves you correctly. We did not need a license
at
all. You could literally come in, be anybody. I think you had to be fingerprinted back then, but that was it. You could be anyone off the streets. And what's changed, to answer your question directly, you need to be licensed. You really need to be experienced. You need to be trustworthy. You need to be somebody that's reliable. You are dealing with people's livelihood. You don't want to make a mistake. Mistakes happen, but you really want to be considering people on like a holistic level financially, no question. You can't say, I hate to use the example of Rocket Mortgage or another mortgage company that's just an online platform. What happens with that is you're just getting the basics. You need to be in a place that you have an experienced loan professional who is licensed, who knows what they're talking about, who has years of experience that can lean in and say, let's look at your overall financial picture. Let's look at what's happening in the market. Let's get real about where you're buying, what you're looking to do with your financial needs. Is this a long-term property? Is it a short-term property? So it's very different now than it was back then. We were just accepting a lead. Now it's relationship building for sure.
Yeah, and I think when you talk about like Rocket Mortgage, I know you have to fit into a certain box if things are not as cut and dry. And in your business, there's always the other side of the story. They have maybe their own business and they're not showing the profits, and you have to be creative. One of the things that I want to just kind of get out in the open early on, because there were some shady things happening in the mortgage industry prior to 2008 and leading up to that cycle.
Absolutely.
And a lot of people say that we'll never have another crash like it because we don't have the liar loans and things like that. I look at it as FHA is the new subprime lender, and certainly there's a meltdown in that right now. Delinquency is almost 10% currently, and they're, despite years and years now, almost 4 years of forbearance and foreclosure moratoriums and things like that. But our industry, the sales side of things, we we have a really bad sort of rap out there. I mean, they think of agents, and I'm not defending it, but they think of agents as, one of the reasons why the housing market is so expensive. They look at, they think of us as, no better than used car salesmen, not slamming on used car salespeople, but hey, I mean, they have a reputation too, right? How it got started, I mean, who knows? But you guys have kind of like escaped that.
Yeah.
And despite all of the wrongdoing that so many loan officers did, people don't look at the real estate industry as like the lenders are bad or these monsters that they consider real estate agents to be. But you guys make it questionably, as much, if not more. You add more cost to the transaction, maybe than real estate commissions alone. And And I just want to talk about that a little bit because nobody really thinks about it. They think of, I can't buy the house without you.
Yes.
Because very few people can afford to pay cash despite all the crap you hear about. Oh, they're just all these cash buyers. Yeah, there are cash buyers in the marketplace, but nothing like the amount of people that need a loan, a mortgage.
Yes.
But the difference is you guys get your fees up front. They got to have money to pay you, right? They can't really roll those. They can't finance your commissions, essentially, like they say that they do on the real estate, on the sales side of things. Well, what do you have to say about that? I mean, again, I'm not trying to pick on you, but I feel like they're really, it is kind of offsides because I look at the money that you guys make. I know plenty of people in your industry, and I'm like, man, you guys have more boats, belong to more clubs, belong to, drive the fanciest cars, right? And you get the bulk, a larger lion's share of a business because agents are really giving you guys leads. But tell me, what do you have to say about that?
Yeah, you put a lot in there, and I like hearing it. It's funny to hear. So I would say that just to back up for a second, we had a terrible reputation at one point. Terrible. I mean, I would say to somebody, they'll ask, what do you do for a living? I'll say, mortgage professional. This is what I do. And immediately people make a face of like, they cringe, like, sorry. Almost they were sorry for my career. I would say right around 2006 to 2012. So there's a pocket of time where people are like, that used car salesman, that's a tough industry. Like, it must not feel good at night to be that person. The industry has changed significantly for my side of things, right? The banking side, the mortgage side, for a couple of reasons. One, I think we are a necessary part of the process. Like you're saying, there are only so many people that can afford to just write that check and not have a mortgage professional in the process. They're going to need a loan. Simple. I think the industry has changed significantly because when 2006, 7, 8, 9, all that time happened, when that crisis, which truly was a crisis, happened, it did shake the tree. A lot of professionals, I wouldn't even call them professionals, a lot of people that were industry that should not have been in the industry left. They shouldn't be there. Reputation matters. In the last, let's say, decade, reputation matters more than almost anything. Just like a real estate agent. Your reputation matters. You have to be truthful. Somebody is watching, which is good. I think that was a necessary part of it because it was really messy. I would say we're fooling ourselves if we don't say that we weren't part of the crisis back then as mortgage professionals. Doing the wrong loan for wrong people for the wrong reasons. That was absolutely a problem, no question. That has changed significantly, to be very honest, in my opinion. In the last decade, you have people with experience, you have people who are licensed, you have mortgage professionals who care about the clients, who care about the referral partner that's part of the process, care that it goes well. And maybe I'm just speaking for myself. There are certainly people that are in it for the wrong reasons. That said, to answer now your direct question, we have our fingers in the pot, no question, we do. So does the title company, so do real estate agents, but we are part of it, and we do make commissions. The larger volume you do, the more you make, no question about that. I would say that the lender itself, no matter what bank lender you're going through, will have fees. On top of that, if you want to buy that rate down, that's an additional cost that's called a discount point, which really just discounting the rate. It is a cost that's part of it. And on the back end...
And that's very expensive.
It can be, yeah. If you're buying $1 million property and you're paid 2 points, that's $20,000. I mean,
Yeah, but it really doesn't drop the interest rate 2 points.
No, you're right. You're exactly right.
I mean, let's talk about it.
Is it worth doing? Sometimes is the question.
Let's just say 7.5%. It's not like you bring 20,000 and you're now at 5.5%.
Todd, you are so right.
Explain that.
Yeah, that's a great point, and that is a great point. So yes, it's only dropping at maybe 0.5%.
Right.
You're exactly right. And in long term,
2 points equal 0.5%.
Right. That's right. So I would back up and say it's really important to do the numbers and make sure for each individual client they feel like they're getting a tailored experience. Does it make sense? And sometimes the answer is no. Often the answer is no. It's better to wait and see if a refinance happens. It's also better to get into the right loan, feel comfortable with your payment at the time. But yes, it's very expensive to get a mortgage. It is. Not only paying a high interest rate sometimes, you're also paying certain fees. To be frank about that, yes, as mortgage professionals, we make money. It is part of the process, no question. That means we need to give a very high level service. If we are not giving a high level service, shame on us. Yeah.
I want to get back to the fees part of it. I want to talk a little bit about the current state of the market because, I hear a lot of... it's hard. Out of all the, and look, you're a professional. I mean, you're one of our preferred, referral lenders. Mm-hmm. Obviously, you wouldn't be if we didn't think that you were good for the client. We certainly wouldn't affiliate that with you or your team. But there's still a lot of cheerleading that's going on in the marketplace. I mean, it's almost sickening. And I get it out of a commission environment. We need to pay our bills. We need to pay mortgages, but you can still do that. There are still people that are transacting business that don't care what the interest rate is. They don't care what the price is. It's a lifestyle for them. They've made decisions who I try and really make more aware than anybody are first-time buyers.
Yes.
But there are, when you have commission environment, people that get paid by commission, their tendency is they put their own financial well-being ahead of their client. And they don't realize, I just, watched, I think it was called 99 Homes over the weekend. And Joe, our content director here, said, hey, you should check this video out. It was really horrific because it was all about people losing their home.
Yes.
And to foreclosure. It's probably one of the worst things anyone can go through. And maybe sometimes the reality of things is that the loan officer should be the one to help clean the house out. Or that the agent should be the one to help them clean the house out.
Yeah.
Or help them find another place.
Yes.
Because people don't realize the magnitude of someone losing a home, let alone getting evicted when they rent it, but losing a home due to foreclosure. Mm-hmm. Terrible, terrible thing. So I think that in the industry, the most sickening to me is to hear, constant cheerleading about, hey, don't worry about it. Don't worry about it. The bottom line, Mary, and maybe you can talk to this a little bit, is that most people don't have $5,000 in a bank account.
Yes.
Maybe even less than that, $1,000. And, a lot of these buyers that are sidelined or that have bought in the last couple of years, they needed mom and dad gift money to even buy. It's a false sense. That's the narrative that's out there, is that the economy is great. If you don't buy a house now, you're going to miss the boat. The pressure that we put on these people, and your industry being no different. What do you say to buyers out there? How are you able to look at a buyer and, talk to them now and say, when is it not appropriate to think about buying a house?
Yes, to everything you said. Yes, and we are cheerleaders. And I will say, to be frank, I'm an optimistic person. I do have an optimistic tone. There's no question. That said, I'm also realistic. Right, we are friends. I'm part of the team in this way, and I agree with everything you say. You are right. Buyer beware, be cautious. We need to lean into this because the reality is if we just sit on the sidelines cheerleading, we're going to have a housing crisis. We're going to have a foreclosure issue. We're going to have people in, disarray with their finances. There's no question. And there are plenty of people in my industry that do that. There are plenty of people that sit back and be like, yes, you're pre-approved for this amount. Buy that house for $500,000 without really counseling the client, without really looking at their full picture. And it happens all the time. And that is where the crisis begins. That's what happened before, 2006, 7, 8. It was all very money hungry, unfortunately. It was leaning in. It wasn't leaning in. It was leaning back and saying, well, that's on the client. That's on the buyer. That's their mortgage. I wash my hands of it. And that is a problem. And it still happens now. There's no question. I will talk to clients. I take multiple applications every day myself and my team. And I will hear from them that they have heard from multiple mortgage professionals, I'd say unlike myself, saying, oh, I can buy that house for $700,000. I can afford it. I'm good to go. And that's all they hear. And that is partially a big part of it. The mortgage professional really steering and saying, you're good. Right. You're great. You're pre-approved. You're good to go. You check all the boxes. The problem really is, which is what you're alluding to or directly asking me, is if we don't turn around and say to that client, yes, you are pre-approved for $700,000, but you should in no way buy at that number. That is a number that should be the dream number that lives there and you never touch. Because the reality is maybe you should be buying more like $400,000 or $500,000. Yes, you can go to 43 or 45 or 57% debt to income ratio, which is your debts on
57.
If you're doing an FHA loan and you have all the right criteria, more than half of your income that comes in before it's taxed, so gross, can go that high, which is why FHA is a great product for certain clients if it's counseled correctly, but it is not a great product just to put a client into, which is what you're saying. And I agree with you. And so it's a problem. And if we're not turning around and really counseling the clients to say, let's go through your overall budget. Let's talk about your goals. Are you going to be in a place that you have kids? Are you going to be considering what schools you're into? What are the property taxes? What are the homeowners insurance? Really looking at it like holistically. Have you put money away for your retirement? What is your game plan? Are you just kind of living paycheck by paycheck? Because there are a lot of people doing that. And you're right. They don't have more than $5,000 in the account. There's no way they're going to make that happen. There's no security. There's no safety net. It is a major problem. And it has changed. And we as a mortgage industry really should take ownership of that. Because as a real estate agent, you're showing them the houses. We're working in tangent together. But really when it comes to the numbers, the finances, getting intimate about their financial situation, it's on our shoulders. And if we're not doing that right, we're really hurting the entire economy and hurting each individual client. No question.
Do you find it disturbing? And I want to get back because I want to talk to the buyer and kind of tell them what they should have financially.
Yes.
Months of cash in the bank, expectations on closing costs, buying a house, because they don't know. A lot of them don't know. But do you find it disturbing that FHA, that the government, a government entity, do you find it disturbing that they will allow a borrower a 57% debt to income ratio to buy a house?
Direct answer, yes.
I mean, this is probably why 1.3 million households already, and that number is probably way low,
right,
have had some type of forbearance.
Yeah.
Whether it was, directly during the pandemic until the foreclosure moratorium went out in July of 2021. Then the American Rescue Act, the HAF, that was part of that gave almost $10 billion to the states. $10 billion.
Yes.
After over a year of people not needing to pay their mortgage and with zero implications, they couldn't foreclose. Then the government gave almost $10 billion to the states, divided it up for them to give to people for housing related costs. Some of those are still active.
Yes, I'm aware.
I mean, I think it was like 24 or 26 states. I just calculated this actually last night for a podcast I'm going to be on later today. But I think it was like 24 states, still the what is it? It's HAF, is that what it is? I think it's HAF. But anyway, the Homeowners Assistance Fund, that's what it is. Yeah. It's HAF. And they still have money available. So for pandemic-related stuff, COVID, now look, I'm not saying that we weren't prepared for this and it wasn't a big thing, but 4 years later, if you have COVID-19 related financial problems, you can still get money from this fund to pay things like your mortgage, your homeowner's insurance, your taxes, your utilities. I mean, I was looking at different states, and they were paying internet providers as part of this fund. The issue here is that we're dealing with the industry putting people in houses that don't have the financial wherewithal to own a home.
Or a safety net, right? Let's say all of a sudden there's a problem with the roof. There's a leak in the roof, problem with the basement. If they can't come up with the money without then putting it on credit cards, right? It's one thing to put it on a credit card as long as you have the funds to be able to pay the credit card down and pay it back quickly. But if you're just, you're trading debt for debt. And so you're right, it becomes a problem. And that is where foreclosure begins, right? You can maybe just barely make that mortgage payment. I say this a lot, that you don't want to have a mortgage payment that you go to bed at night and you think about your mortgage payment. Then your mortgage payment is too high. There's no question. You need to be able to sleep at night knowing that everything's fine. You have enough money in the bank. You have savings. But right, if my industry, who is at fault, is putting people into those loans just to really, in some way, be selfish, right, to serve their own pockets, that is absolutely a problem, no question. And then that problem happens with that house, or that, they're needing to make a job change, or they lose their job for a certain amount of time, or one family member, God forbid, passes away. Life happens, right? Life happens even though that mortgage statement comes in the mail every month. And if something happens to the house or somebody financially, it can absolutely put somebody in a tailspin and start in that direction of foreclosure, unfortunately, and that happens a lot.
I took clients out this weekend to look at a house that is what we consider overpriced, about $100,000 to other comps in the neighborhood. Yeah. And the listing agent's response to the expense was that there were a lot of niceties added to the home. They only bought the house 2 years ago. Yeah. And they need to move, closer to, 20 minutes away or 30 minutes away to get closer to a certain area. And they're tired of driving. I mean, this is a big thing. Buyers went on further out areas, but they bought it in 2021 for $150,000 less than what they have it listed for. And my client wants to give them $100,000 less, which still falls in about the 560 range. Yeah. Of course, they didn't accept the offer. But in talking to my client at 7.25%, they were looking at a $4,600 a month mortgage payment.
Yes.
Right. And looking at that, they were petrified. They said there is just no way, as two self-employed people that coming into an economy that's so uncertain, do they want to put that type of financial pressure on themselves. Let's kind of talk about the what do you want borrowers to have, and not the Mary in the industry that wants to pay your mortgage or gain a commission check. And I know you're not like that, but I'm just saying, in speaking to somebody, if you had to say you retired from your industry, or you're talking to your kid, and you knew what their financial situation was. I mean, what do you tell these people? How much should they ideally be putting down? Because, when people say, oh, well, if you put down 20%, you don't deal with mortgage insurance, which people don't realize that's the biggest ripoff there is. Mm-hmm. That's the most expensive, probably shy of, climbing cell towers. Yeah. What a company would pay in insurance to climb a cell. I mean, dollar for dollar of, what you're paying for what the insurance company would pay out. One of the largest, highest risk per dollar insurance premiums is your PMI, right? What do you tell people? Because when you say to people, well, if you put down 20% or you have 20%, if it appraises for 20% less than what you're borrowing, you don't have any PMI. And people look at that number and they're like, man, I got to put down what? $150,000 in a $500,000 house in order for that to happen? They don't have that kind of cash.
Yes.
So what do you tell people that want to buy a house that will give them or offer them the biggest safety net without cheerleading?
Yes. Okay. If I were to be out of the industry or stay in the industry, because it's what I do now, I would say, first of all, we need to just take a step back. If you found a house today and you came to me, if you found a house tomorrow, you're looking for a house, and you came to me today, we probably should have been speaking 6 months earlier, right? If you're a perfect financial person, you have great credit scores, you have money in the bank, you're a salary borrower, you kind of tick that box. If you're a person that is not perfect, which is 95% of us, I would have said we probably should have spoken a year ago to prepare for buying that house. It's when people enter into the market and they say, I want to buy, I want to buy. And usually what I find is they're often wanting to buy because their lease is up. So they're feeling the pressure of time. They shouldn't feel the pressure of time. That is part of the problem right now, is buy when it is right for you. Get your finances in order. So I would say, let's back up and make sure your credit scores are in order, because that's going to impact your interest rate, no question. It's also going to impact which type of loan we do. When you bring up PMI, if you can be in a place that you do a conventional loan versus an FHA loan, you're a step ahead, because that PMI cost will be less or nothing. 2, you'll get a better interest rate, most likely. So I'd talk about credit scores. I would talk about your debt to income ratio.
Where should their credit score be?
So,
I mean, what's going to get the borrower the absolute best rate?
740 credit score.
740 or better.
740 or higher is going to give you the very best of the best. You're considered like the top tier credit score.
Okay.
And then 20-point increments below that is just tier every 20 points in terms of that credit score. 700 credit score is still excellent, though. It's not top tier, but it's still excellent. 680 is considered a high average. Still good, but not great.
What's FHA go down to now?
It goes down to 580, but really a lender probably won't lend unless you're at least 600, 620.
But FHA will say if you have a 580 credit score,
yes,
you can technically buy a house.
Yes. Yeah.
Yeah.
It's even lower than that, but that's where it really starts.
Right.
Let's say it that way.
How about as far as money in the bank?
So money in the bank.
After everything.
Yes.
After they pay everything, closing costs,
down payment, you're going to need, I would say, 8.5% between it all. So what does that mean? That means you're 3.5%, let's say FHA, 3.5% down, plus let's say 5% in closing costs that you're going to need. So 8.5% altogether. Short story, $100,000 house, you would need a total of the 3.5%.
$8,500.
$8,500, right? Exactly. Yeah. But the reality is, if you're buying a $100,000 house, do you have $8,500? Probably not, right? You're probably in a certain financial position. And also, what does that house look like? What is that? I don't even know where you get a $100,000 house. Certainly not on the East Coast and West Coast. I mean, that is a house that is potentially distressed. It needs lots of renovations. You're buying a problem home.
But if you go by that, so you figure $17,000 if it's a $200,000 house. I mean, it goes incrementally.
Exactly.
So they need that.
In some fashion, they're going to need those funds, whether they're getting it from a Maryland Mortgage Program assistance, you're getting it from some sort of down payment assistance program,
or each state has
family
it.
member.
People
Every state has, right? Some version of it, right? If you're in Florida or California, or where, then you're having a different product, but something similar, a down payment assistance program, or you're asking the seller to cover some of those closing costs for you. If you're an FHA product, they can all be covered. All of the closing costs be covered by the seller if they're willing to do so. Right, because it depends on the scenario. But the less money you have to put stake in the game, skin in the game, the less money you have, the more vulnerable you are. And I also like to say to people, and I'm a conservative person when it comes to money, you need to have a safety net. You really do need to have money in the bank that, God forbid something happened to the house, which at some point probably will happen. You need to have a certain amount of money.
How many months?
Yeah, I say 6.
Yeah,
Some people
too.
say 2 or 3. 2 or 3 is a great start, but if you have 6 and something happened, it will not be life altering.
That covers all of your costs.
Right. It won't be the panic that will start to set in. If you only have 1 month, it really isn't enough. You can do it, right? The government, right? FHA allows you to do it. You can show 0 reserves, just the money needed for closing, and call it a day. But if you have that extra safety net, this is my optimistic side. If you have it, you're walking into it, you're probably ready to buy a house if that feels right to you. Reality, if you have 5 or really 10% down, I would consider you a very strong, confident buyer. You can go in and lean into any property that you want as long as you're okay with the payment. We talk debts on a monthly basis versus income. I like to say 33 to 35% is where you should really live. And that debt to income ratio, really good credit scores, which I can help you with, and not really debt heavy. A lot of people in my world are entering to the market and they're in their late 20s or early 30s, and there's a lot of student loan out there, lots of student loans, and that becomes a burden in their world. And the question is, what's the game plan? right? What is your income? Are you going to be able to afford that?
Well, their game
payment?
plan is they were hoping that the administration was
Yes.
going to write it off. And now
Yeah.
that they realize that that's not happening.
I
their
didn't
game
say that,
plan
but that is what went through my head.
Their game plan is they need to start writing checks,
Yeah.
which they should have been doing when they had free interest.
Yeah.
I mean, what these people that have student loans where they made a mistake was they didn't pay down that debt when it was 0% interest, when the government wasn't charging
Yeah.
interest rates, right? Should have taken advantage of that, bought down the debt.
And part of it, there's no direction, right? People will come to me and say, what should I do with my student loan debt? That is not what I do. I'll certainly give you some really good advice from person to person, but that isn't what I do. There should be some counseling before you even get that debt, really it shouldn't be such a mystery all the time. We need to take the mystery out of it. So let me answer your direct question, which was, how would I prepare my clients? How would I have my 2 kids buying a house? They aren't at that age yet, but when that happens, I would like to see them have 10% down. It would be my preference that if they can get themselves in that place, which means starting at a young age, out of college, they need to start getting their finances together. That is on them, but it is on the rest of us to make sure we're guiding them, to make sure to set them up for success. Because if they don't have a certain amount of money down, there are certain loan products, but they're not taking advantage of the best product, the best option. That's
Yeah.
And FHA, listen, I know FHA is a concern. We all have it. That is a product for a certain client who also, that client needs to have some money in the bank. They just do. If they're walking around, the concern I have is people will put a client into that FHA loan and not guide them to say, how much money do you have in reserves for that thing that is going to happen, to make sure that you're not left out to dry, which is the concern.
Well, the 10% is a good number to have down, from a resale standpoint. I mean, what we see is a lot of people, just like the example I just gave, where the people who have been in the home for 2 years, they bought at the absolute height of the market in 2021. They won $150,000 more because they spent money putting new flooring and doing some things which really doesn't matter. Your house isn't worth $150,000 more because you spent $40,000 in flooring of hardwood flooring in your house. That was the choice that you decided. That's dumb, because a lot of people may not like the color that you picked.
Right.
They may not like and with my buyers, they have dogs, so these expensive hardwood floors really aren't an add-on to them. But to your point with the 10% down is that it costs you need about 10% in equity in your home, not giving any fluctuation in price, where prices are coming down, downward pressure now on pricing. You need about 10% equity in your home just to not come to the table with a check.
Right, to
if
resell.
you need to sell.
That's right.
You'd want to take a job, in a different state, and you want to move, and you made a mistake by overpaying in 21, $50,000 over appraised value because mom and dad gave you gift money, and it was allowed to happen.
Yeah.
But I think and I do agree. I think 6 months certainly good. I do want to address, though, just to kind of circle back around to the FHA allows you to have the entire down payment, what they require, the 3.5% down paid by the seller. And I just want to talk to buyers out there. If you're looking for a home and you need the seller to pay for your closing costs, you really knock the legs out of your negotiations.
That's true.
You really are screwed with asking for anything, because you're more focused on the down payment to help you get into the house than you are even overpaying for the house or buying something that is problematic or is going to be a money pit or cost you money moving forward. So the less desperate you are with the necessities to what you should at least have the necessities to collectively buy, at least your own 3.5% down or your 3% down at a bare minimum.
Yeah.
If you don't have that and you're asking the seller, you're probably paying higher than you would be able to otherwise do. And you're also dealing with properties that there's not a lot of interest in.
Yes.
Because there are so many other qualified borrowers out there, or buyers, that will either pay cash or have the down payment that will knock you out because they're looking, sellers, or if they're well advised, are looking at what's the probability to close, and the one that needs all the down payment assistance is probably less probable to close than a borrower coming with 20% down or paying cash.
Yeah.
No borrower at all. Let's talk a little bit about you've been in the business for 20 some years. I've been in the business going back to 1989 as a contractor, well before my license, became a licensed salesperson or now a licensed broker. This market's starting to, we talked a little bit before about behind closed doors. I mean, obviously, and I always use the analogy, you have two personalities almost, not you, everybody.
Yeah.
Who you want people to see you as, and then when you get it home at night and you shut the door and you're like, look in the mirror and go, oh, freaking, what the heck? Yeah. What is happening? What are your biggest fears moving forward with the industry? Do you think we're going to have an Armageddon here when all of this this debt crisis catches up?
Yeah. One of my biggest fears, I would say, is that our industry makes up 15% GPT, right?
Questionably more.
Right.
Questionably more. If you do housing services, it's probably more like 34%
right. That's
of
a good
GDP.
Point. That's right.
Or CPI.
Yeah.
Certainly.
And so our industry is shrinking, right? I think of a few things. When you ask that, my direct answer would be job markets. What's happening with that, right? Our own industry. Things have tightened, no question. People have left our industry. Totally great. That's fine. They move on to other industries. There's other industries to enter into. The last quarter has been, it's been slow. The question really comes down to, why are people buying? Why aren't people buying? Why are people selling? Why aren't people selling? And what's going to change? That's what keeps me up at night. What is going to change to make sure that the housing market keeps moving forward and we just aren't too stagnant for too long? And we need some changes to happen quickly. One thing that I think about is interest rates are coming down. I would like to see them come down more quickly. The Federal Reserve is going to meet a few times over the next 2 quarters. We need to see that happen. And it would be great if it was more than just a 0.25% change. It keeps me up at night a little bit. I think the rates are going to come down to where they should. Pre-pandemic, they're in the upper 4s, low 5s. It'd be great to see them there again. That's going to change the industry because it'll allow people who are right now at 2 or 3% interest rate to say, okay, we're close enough, I'm okay to sell. The other thing that keeps me up at night or concerns me is the speed of this. How long is this going to drag on for? Is there a recession? I mean, I am not like I said, I have an optimistic tone, but that's right. Is that a 2024 concern? Will there be a recession coming? Is it a soft landing? I'm using words that obviously the government uses, but these are words that I also use. I would say debt is a concern that I have, that people have, individual debt. I can see from my own clients who I speak to quite a bit. I've closed over thousands and thousands of clients. I have databases of clients, even people in my world. Is debt a concern? Are they able to make their own mortgage payment and then the debt they're accruing? Student loans are a concern right now. I would love to see, in some way, each person that at least enters into my world be counseled correctly to make sure that they really have their eye on the ball. And that also means, short term, are they buying? If so, does it make sense? Or should they lag it out, put a little more money away, get into the right loan? I've plenty of veteran clients who are fantastic. A veteran client coming and doing 100% financing is absolutely fine as long as you have some money in the bank. It's a great product. It's a great program, low interest rates. The thing that I see this year that is, I would love for people to really sit down, self-reflect, talk to a financial professional, which isn't necessarily what I do, but it is part of what I do, and figure out, are they in the right direction to build that safety net for themselves? Because if they are just accruing debt, it's a big concern. And I think when people feel financially secure, they will go out and purchase. Right now, what I have seen is an influx of buyers entering into my world just in the last couple of weeks. But are there houses to buy? No, the inventory is very low right now, which people aren't selling.
You were saying they weren't qualified either anyway. I mean, a lot of them weren't, right?
Yeah, some of them do need some...
You said action plan or some kind of whatever.
Yep, they'll need an action plan to make sure they have the monies to... Because you're right when you say, well, if somebody's going to buy and they need the down payment assistance, plus they need the seller's closing cost assistance, it just isn't... We can make it work, but is it really the right thing for them? I would say directly to a buyer, I would I would back up and actually save some money. I would save some money so you have some skin in the game. You feel confident. You're not just relying on the system in some way to make it work, because in the end, you want to have that money saved. You want to have enough money saved that you're
not to change the wheels a little bit,
Yeah.
but we're getting a little bit off of the direct question.
Yeah, what concerns me.
I mean, do you think that we're going to be looking at a massive housing recession?
I wouldn't say massive. That's my from where I am. But I do think we're going to see values come down. I do see the decrease in values, no question, in my opinion.
I mean, we have more inventory in new construction. We have over 7 months of new construction inventory in one of the worst times of the year to have it.
Yeah.
You just said that if the rates come down, if we have a crash in the bond market, which is predicted, a lot of the bond experts are saying that we will see a crash in the 10-year bond, which will drastically lower interest rates for a short period of time. I don't think 7.7% has been the average decades over the last 50 years in mortgage, 30-year fixed rate mortgage. I don't think it's a good thing to see 4% again, or even below that. Do you think it's going to I mean, in 2007, the Fed dropped the overnight trading rate to 1%.
Yes.
And we had a massive crash. The bubble's so much bigger now.
Yeah.
Do you think dropping the interest rates, the Fed rate, even though it's not directly correlated with mortgages, it mirrors in many ways with the bond market. Do you think that the Fed comes out and drops the Fed rate? And that would be drastic, by the way. For them to drop the rate to 1%, I don't see happening anytime in the next 2 years. We have new administration, probably. Maybe it's the same administration, but 2025 is going to be a different year. They call that lame duck or whatever, where, I mean, what's going to really happen is they're going to focus on, if it is a new administration, and reversing executive orders and doing all kinds of crazy stuff. And, so I don't see anything happening through 25. But well, it's interesting. We'll circle back around.
Yeah.
So we'll see. We'll see what happens.
Yeah, we'll see what happens.
I'm a little more obviously bearish than bullish in the housing market, just because for the first time in, since they've been tracking it. And by the way, terrible data from the National Association of Realtors. Mm-hmm. Terrible data.
Yeah.
I downloaded a report last night, prep for what I was mentioning, this podcast coming up. And their direct information that I have at my fingertips, directly from the National Association of Realtors, not Fred, who's the Fed, but gives me data over a year old, so can give me the HAI to December of 2022. That's pathetic.
Yeah, the
First
lag
of all,
is,
if I can't get any HAI reports from the National Association of Realtors in now over a year, coming up on 13 months, 14 months of information, I can't. I mean, I have nothing to go by. But for the first time in 20 some years, well encompassing the GFC, the housing affordability index was under 100, at least in 2022 was under 100, and on Fred looks under 100 into 2023, at least the end of 2023, which means that the median income household can no longer afford the median priced home.
Yes.
First time, even in 2006, the height of the market, it was never under 100. So anyway, well, Mary, we appreciate you sharing all your knowledge and your expertise.
Yes,
and
thank you so much.
Any parting words other than don't become a loan officer?
Right.
I mean, I'm kidding, obviously.
Yes,
I'm sure
yes.
It's a great career, just like people say, don't become a licensed
if you
real
do it
estate
right,
agent.
right? If you do it right and you're that trustworthy person, it can be a great career and you can be helping people and it can feel good, no question. I would just like to say that I've been watching your podcast just 4 years ago, when you first started putting content out there. And I have said this ever since. When you're putting something out there, I try to watch and listen because you give it to people straight. It's not being reported. There isn't enough information out there. People kind of feel blind in the world of what's happening, and you really, really put some context to it and put some graphs and charts, and you really educate the people out here. So
I
I just
appreciate
can't
that.
thank you enough. Yeah, no, it's great. It's great to watch.
I'm
and
not
listen.
invited to any realtor parties. I can tell you that, unless they're my
Sure
own
you are.
realtors. At least I don't get the invitation. I mean, maybe it
Yes.
gets lost in the mail, but
Yeah, no.
well, thank
You're
you
always
so
invited.
much.
You got it. Thank you so much. I appreciate you. Yeah.
All right, there you have it. So Mary, she's kind of nice, huh? I mean, some people think I'm a little too tough when I'm interviewing people, but she could handle it. And you know what? I do trust her. I think that, she was forthright in what she was saying. And I think we need more transparency in this business. And I think we need to kind of slow things down, acknowledge the unaffordability of the housing industry of today. Guys, I'd love to know what you think. If you like the video, you can smash that thumbs up to let Mary and I know that you did. And I really value your comments and questions. You can drop them below. We'll be sure to check them out. And if you haven't already subscribed to our channel, what are you waiting for? Now's your perfect opportunity. You can hit the subscribe, hit that little alert bell. You'll know every time we upload videos just like this. See you next time.